Good afternoon. It's Jeffrey, Christian CPM Group. It's 3 minutes after 1 o'clock on Tuesday afternoon, July 9th. I want to talk about several topics today. Try to go fast. As I speak, the price of gold is around $2,370. Silver is about $31.23. I want to mention a little bit about what it means to take delivery of silver or gold futures and physicals. I did a video about this 21st of June, and there were some questions that made me think that I should perhaps explain the mechanics of futures as opposed to physical metals, and also update on the situation with the July Comex or futures contract. Then I want to talk a little bit about how much gold and silver you should own. It's something that people keep asking us. And I want to talk about market update in our outlook. So a lot to cover. Let's see how I can do it. First, taking delivery. One of the important things that some people, maybe less than 1% of the people that watch our videos, have a question about what a futures contract is. A futures contract is a futures contract. It is not physical metal. It is a contract that allows you to get physical metal through a futures contract if you wish. There is a tremendous amount of trading that occurs in futures because there are companies that want to hedge their exposure to silver price changes or any other commodity price changing. Futures contracts and futures exchanges were created by merchants so that they could find investors to whom they could lay off their exposure to commodities that they were buying that they wouldn't have delivery of for a long time. People in Europe would finance a ship to go to Asia to come back with spices and coffee and tea and silk, and they would be paying for it, and then it would be months later before they got it in Europe and were able to sell it. And the price could vary, so they would find investors and say, hey, do you want to take a chance to earn some profits by agreeing to buy this stuff at these prices? That's where futures contracts came from. Futures contracts are obligations to sell and to buy commodities at a future period of time. Now, when you make or take delivery of a futures contract, you're not physically moving metal. And if you think about it, the person who has sold that futures contract, that short the July contract, if you will, has sold that metal already. And the person who has gone long the July contract has bought that metal already. So the delivery and transfer of the warehouse receipt that is backed by that contract, that is the consummation of a purchase and a sale that was done some point in the past. So there's no direct price consequence of people consummating a transaction that was done in the past. The price consequence occurred when somebody agreed to sell short for future delivery and somebody agreed to buy long for future delivery. So making and taking the delivery of the futures contracts doesn't necessarily have a price effect. It can under certain circumstances. Typically it doesn't. What happens is someone has agreed to sell into the July silver contract, and they probably have put up warehouse receipts for silver in a Comex registered depository, or they haven't. And if they decide that they don't want to make that delivery because they don't have the silver in that warehouse perhaps, or for any number of 1,000 other reasons, they buy back that futures contract that they sold short earlier. If they want to deliver, they go to the Comex clearinghouse and they say, hey, I have given you warehouse receipts for X ounces of silver. I'm going to deliver it into the July contract. And the delivery process starts with the shorts informing the Comex clearinghouse, we want to issue a delivery notice for that contract that we've sold in the past for July delivery. The clearinghouse then randomly assigns those delivery notices to people who are along the July contract, and they take delivery of that contract. It's a warehouse receipt that they're taking delivery of. What they do with that receipt is up to them. A lot of times they sell it back within 24 hours because they don't want to put up the full value of the silver in covered by by that contract. Sometimes they leave it in the depository. Sometimes they move it from one COMEX depository to another. Sometimes they take it out of those depositories. Sometimes they take delivery of it and they actually use it. Most producers don't get active in delivering through the COMEX, and most fabricators don't get active buying off of the COMEX. They use principal-to-principal agreements in the over-the-counter market. But some people do make and take delivery of physical silver through the contracts. So when you see people talking about deliveries of futures contracts, issues and stops, they call it, delivery, issuing a delivery notice, stopping that delivery notice and say, okay, I will pay the full price of that and take delivery of that. That's not necessarily physical metal. The making and taking of physical metal mostly happens in the over-the-counter market. Transferring the ownership of the warehouse receipts of the physical metal behind the futures contracts does not necessarily have an effect on the price or the availability of physical metal there. So let's look at some numbers. These are the issues, the commodity delivery issues that have been given to the COMEX clearinghouse for the July contract since the 27th of June. And you can see 5,632 contracts so far in what is this 3, 6, 7 trading days. And you can see the first delivery notice was actually the 27th of June, 2 days before the first trading day in July. So that's 28.2 million ounces of COMEX futures that have been delivered in the past 7 days, during which time the price of silver has been basically flat. Not 28.2 million ounces of physical silver necessarily. I guess it is actually, because those contracts have silver in the depositories against it. The ownership has changed. The deal to buy and to sell that metal was done earlier. It has been consummated. So 28.2 million ounces of COMEX depository silver has changed hands over the last 7 trading days. And as I said, didn't really have too much of a noticeable price. As of Friday, the data, the COMEX depository statistics that came out yesterday covered Friday. As of Friday, you had 69.98 million ounces of registered silver and another 229 million ounces of eligible but unregistered. The 69.9 million is actually up a little bit from where it was recently, last week. So there's been a little bit extra metal that has been transferred from the eligible inventories into the registered stocks. And it's up from 63 million ounces at the end of May, when you had 733 million ounces of July open interest. So at the end of May, you had 733 million ounces of open interest in the July contract. Today, you have 536 contracts, which are equivalent to 2.7 million ounces. So 731 million ounces of July COMEX futures contracts were either rolled forward, most of them are rolled forward into September, or closed out, or delivered into. Of that 733 million ounces, A lot of it was gone by the time the first delivery date came, and 28 million have been delivered so far this month, with 2.7 million ounces left for either delivery or closing out between now and late July, when the July Comex futures contract closes out and goes off the board. So that's how the Comex works. Some couple pieces of data. Silver regularly is delivered along with other commodities via futures markets. As I said, a lot of commercial business is done OTC for a variety of reasons, but some people do buy and sell. Of the deliveries, a lot of them consist of metal that stays in the inventories. And it's important to note that deliveries go into depositories as well as coming out. So people will look at the deliveries and they'll say, oh my God, look at all the deliveries being taken. But if you look, for example, I believe this is April of 2020, during the crisis and the lockdown, there was a tremendous amount, like 80 some odd million ounces of silver that was delivered into the Comex inventories. Comex reported inventories, including registered, these are just registered inventories. Registered inventories went from around 80 million ounces to around 150 million ounces, right? So you had about 80 plus million ounces delivered into the Comex, and the price was actually rising at that time. So the deliveries include deliveries as well as people taking the metal out. And you can see that there's a fair bit of cover, usually more, between the deliveries and the registered inventories. And if you look at it with registered and eligible inventories, you see that there's this enormous range between it, where deliveries are down there below 50 million ounces in a given month, and inventories are now up around 299, 300 million ounces. And there's metal that is not in the Comex network of depositories, and there's metal flowing into those Comex depositories almost every day, and metal coming out almost every day. So there is some metal that sits there for a long, long time, but these are working depositories where refiners will deliver metal to be stored, not necessarily to be registered on the Comex, but to be stored safely in a competent depository and recognized depository, and industrial users, investors, and others will take it out. Plenty of metal out there. So how much gold and silver should you own, an investor own? I'm going to show you two charts which are pretty much irrelevant. Actually, they present outside parameters. This is the gold optimal role in a portfolio historically. If you start with a portfolio that's 50% S&P and 50% T-bills, and you add 5%, you take 5% out of those two assets and put it into gold incrementally, and you look at how the market, how that portfolio performed historically from 1968 when gold prices were freed, and 2020, you see that the sweet spot where risk is falling, or it's actually starting to rise after 20%, but it is rising more slowly than the return. So at 25% of your portfolio in gold, historically, your risk had fallen down to about 5.2, 5.3%, but your return was about 7.7%. So you are still improving the overall portfolio's performance while with a reduced risk. If you go down to 15%, you can see you're down to about 5.1% risk, and you've got about a 7.4% return. So that's a really nice sweet spot. People look at this and say, oh, I should have 25 to 30% of my portfolio in gold. Not necessarily. Silver, very similar. It's about 25, 30%. So how much gold and silver should you own in your portfolio? It depends on who you are, how much money you have, how much exposure you have, what are your risks, not just your financial risks. Are you heavily invested in a lot of stocks that if you looked at them and say, oh my God, this guy's stock, the PE ratio, the price to earnings ratio is 100 to 1. He'll never, ever earn enough to justify this stock price. But the greater fools are buying it, so I'm in with them. I'll buy it. Do you have a lot of risk in your portfolio, or do you have a less risky portfolio? But it's not just your portfolio risk that you have to worry about. It's your job, it's your life, it's your livelihood, it's your savings, it's your house, it's your political environment. There are a lot of risks and such. And there are a lot of issues about how much you should have. In parts of Asia, a lot of people own gold and silver as a form of savings. And the gold they own might be in 1 gram and 10 gram little pieces of gold. But that's what they've got. In the United States, you have so many people who don't have, gold's $2,300 an ounce right now. There are a lot of people, if they said, well, I want to buy an ounce of gold, that's going to take up 60% of my cash. And you probably shouldn't have 60% of your cash in gold. If you want to buy a fractional, you're going to be paying a very high premium. Probably doesn't make sense. So in the United States and other European, other industrialized countries, what you'll find, a lot of people buying more silver than gold because a lot of people just can't justify buying an ounce of gold. So they buy silver. The standard market is 5 to 10% of your assets in gold. That makes sense when everything is just sort of bumping along. When you have a very good economic and political environment, maybe it should be toward the 5% range. And when you have a very scary political and economic environment, you probably want to have more than 10%. And that leads us to where we are today. Where is the price of gold and silver going? Gold has been trading $2,300 to $2,400 for about a month and a half now. If you take a broader range of $2,300 to $2,450, it's been trading in that range for 3 months now. 2,300 is starting to look like a very stable base. And the potential for gold to spike over 2,400 is increasing. And gold has come very close. I think yesterday it got to $2,399 briefly on the Comex for the August contract. So the market is skewed to the upside right now on a short-term basis, on an ultra-short-term basis, and on a medium and long-term basis. And CPM Group has been saying that is the case. Where gold goes from here depends on the political and economic and financial environment. And you have to make an educated or an uneducated, a lot of people do uneducated things all the time. You have to make a decision as to what you think the economic environment is, the political environment, your personal risks, as well as the societal risks that you're facing. Right now, things look pretty scary. CPM Group runs a variety of scenarios, both for the next 2 years and the next 10 years in gold and silver. Our main scenario has, for some time, talked about a hostile economic and political environment that peaks in 2024, 2025, maybe spills over into 2026, and then things get somewhat better, and or investors become inured to the risks that they're facing politically and economically. We saw that in World War II. We saw that in the Great Depression. We've seen it in other times too. Initially, the price of gold will rise on the crisis, but as the crisis persists, investors say, okay, I've got my money in gold and silver, and I don't need to buy more, and the price sort of moves sideways. Doesn't necessarily fall sharply. So if you want to know where to think the price is going in the long run, you have to make an assessment or listen to somebody else make an assessment of where you think the world's going politically and economically. Our view has been that things would back off after 2025. Looking at the world today, that's still our main scenario, but we've probably increased the probability rating of an alternative scenario we use where the price goes higher. So our expectation is that things don't necessarily get dramatically better after 2025, politically and economically, but somewhat better, and investors become somewhat more adjusted to the heightened risks that they face. If we're wrong and things actually get worse in 2026, the gold price will go higher in our models, and the gold price will go higher. If things get better, the gold price could come off. The gold price to us looks like it's entered a new range. That's something we've been talking about for 25 years now. If things got better, maybe the price comes down to $1,800. I said that a few weeks ago, and some wag in his comments said, "Oh, Jeff Christian said the price of gold was going to $1,800. Yeah. In a world where everything gets better in the long run. I didn't say it was going to happen in June, but people hear what they want to hear. And if they're the kind of people who write comments, they probably are looking for something to criticize because they want to be critical, even if there's nothing to criticize. That's the way people are. We've learned to live with them. In a low scenario, you could see the price backing off. Not this year, probably not in 2025, probably not in the first half of 2026, but at some point. In the high scenario, price scenario, things get worse and people continue to buy gold and silver, and U.S. Treasuries and the dollar probably are in there too. Our main scenario is that the prices rise over the next 2 years and then start to back off, either because things get somewhat better. I don't think they get solved, or investors just simply become adjusted to a heightened sense of risk. Last October, CPM Group wrote 2 market alerts for its paying clients. One had to do with our long-term economic and political outlook, and it discussed issues related to debt and deficits and spending and debt, global politics, domestic politics, defense spending, wars that have been breaking out. The second one concerned U.S. government deficits and debt, and it talked about how this could be solved relatively painlessly, but the political will's not there. Those 2 reports have held up very well, and actually people are pulling them out of their emails and rereading them because they make a tremendous amount of sense as to how things could get better. But we don't expect them to get really a lot better because, again, the political will does not seem to exist either on the part of politicians or voters. People who vote for those politicians don't seem to want to take even a little bit of pain. So the day of getting things better, probably further down the road. Silver, very similar situation, but silver has shown greater weakness in June. Our expectation is it will continue to lag gold somewhat over the near term. And it will rise along with gold, but it's a very similar pattern. Stronger prices in the second part of 2024 into 2025 into early 2026, and then they back off. The highs that we're looking for are somewhat higher because of the way our models work. We're working off of a higher historical base, i.e. recent prices. Recent prices have been higher than They've been higher. They've reached high levels sooner than we had expected, and that causes the price projections for the next 10 years in our model to increase proportionately because they're being increased off of a higher base. And we're not necessarily saying, oh, the base today represents what we thought would be the peak tomorrow. We're saying, no, we think the peak is still out there in the future and prices will go higher. Next week, we will be launching our Platinum Group Metals Yearbook. We'll have an online briefing that's open to the public. You can go to cpmgroup.com and register to participate and plug in to that briefing. You can pre-order the Platinum Group Metals Yearbook. You can buy the Gold Yearbook and Silver Yearbook. You can look at some of our other research products and our consulting services and asset management, commodities management, and price hedging programs for producers, for consumers, and for investors. And you can send us an email at info@cpmgroup.com asking us, what can we do for you to help improve your price performance and your investment performance vis-a-vis your exposure to precious metals and commodity prices. That's all I have for now. Take care of yourself. Take care of those around you. Do something good for the world, and we'll talk to you Friday.